Let's talk money.
Hello and welcome to another edition of Let's Talk Money with me, Surabhi Upadhyay. Well, a brand new financial year is here. And today on the show, we're going to talk about why April is an important month. Why we should not, push back all thoughts of money, our portfolio, our taxes, and all things personal finance towards the end of the fiscal. It's always a good idea to start early. So the question is, how do we do this? What are the steps? How do we go about looking at our financial plan? Well, to help us answer this question, the guest with me today is Kalpesh Ashar of Full Circle Financial Planners and Advisors. Kalpesh, thank you very much for joining us in the studios.
Thank you.
Let me start by wishing you a very happy new fiscal year.
Thank you, and wishing all the viewers and you a happy new financial year.
Yeah, absolutely. And the last 12 months have been actually very good for investors. In fact, most asset classes have gone up. Equity markets have been roaring. Corrections have been short and shallow. So what are your opening thoughts as we start our discussion today?
So, as we say that normally asset classes move in different directions. But this time, I think it's a very unique thing that we are seeing equity markets at an all-time high. We are seeing gold touching an all-time high. We are on the brink of the so-called interest rate cuts. So all those things are looking very, very, positive and very, I would say, cheerful thoughts for the investor. So in this, I think, mindset, we also need to be wary. And that's why, like what you rightly said, that April is that month where we need to take stock of things.
I'll be really honest with you. For the better part of my life as well, the only thing you think about in April is, okay, I have to give my investment declaration to my employer, and maybe I have to figure out if I have any tax-saving instruments in my portfolio or not. Tell us why that's not the right approach.
No, so I think, that is the most talked about thing in the personal finance parlance, that people say that, you'll push it at the end of the year. And especially talking about something like the tax planning.
Yeah.
People say that Jan, Feb, March of the current year is the right thing to do it. I think that planning should be done now itself. And why that happens is because people still perceive tax planning in isolation. They do not see tax planning as an entire financial plan exercise.
Yeah.
That if they do very, discrete financial planning, tax planning automatically takes care of it.
It's a part
It's
of
a part of the whole process,
yeah,
and not the other way around.
Sure.
So I think that should just go out of the window and consult your advisor, or if you have a good CA, who will tell you how this can be a part of your entire financial planning process. Because then people are prone to mistakes. They do things in a hurry. And all the things which are the don'ts of financial planning, they come into the picture.
So, okay, let's, as they say, let's start from the very beginning, a very good place to start. Help us with maybe a checklist. Where does one begin? If I want to do things right this financial year, FY25, where do I start? What's the checklist?
So, as we say, the end motive of financial planning or your financial profile should be your financial goals. So, no better time than revisiting your upcoming financial goals for this year, and probably I would say one more year.
Okay.
The reason why I'm adding one more year is because you will have time to adjust your investments, your cash flow, and all those things. So revisit your financial goals.
Okay.
And when I say financial goals, every financial goal which we have should have a future value and should have a time frame attached to it. Because we can't just, as we say that your goals cannot be just wishes.
Yeah.
They have to be put down.
Realistic.
Yeah, they have to be realistic. They have to be put down on paper, and you should be able to implement them.
Absolutely.
And there should be action on it. So revisit
That's
your
number
financial goals. That's number one.
Okay.
Second one out here is mark the important dates on your financial calendar. So as we have those holidays, which we always look at first in a normal calendar,
Yeah.
I think mark out the important dates on your financial calendar, which is nothing but, most importantly, do not miss out on your insurance premiums. And here I'm being very specific. Insurance premiums is pertaining to your term plan premiums.
Life insurance.
Life
term.
insurance term, which we always advocate, and not the insurance cum investment products. Second is your upcoming health insurance, because that also you cannot afford to miss.
Yeah.
And keeping sufficient money every time for your SIPs as
Sure.
well.
Okay.
So those are marking the important dates which are there.
Sure.
So you do not miss out on the protection part, nor on the investment part.
Fair enough. So second point is know your important payouts that you must meet.
Absolutely.
Yeah.
On the
Okay.
financial front.
Yeah.
The third one is obviously, I would say, the nerve center of financial planning, which is the cash flow. Because come what may, whatever you are earning, whatever you are spending, if you do not have a handle on your cash flow, believe me, Surabhi, things can go haywire. And people can be living in a complete illusionary state, and they do not know when can the boat just sink.
Yeah.
So understanding your cash flow for the forthcoming year, marking out what are the expenses which you would like to make, and always keeping your expenses below your, the income
Sure.
part which it is. Many times people do the vice versa, and it creates havoc with their thing. So third point is revisit your cash flow and be realistic in that as well. Don't try to fool yourself saying that, no, on paper I might do this, but in reality you're doing something else. So do that cash flow, which is nothing but understanding your income and your expenses. So
Sometimes the converse also happens, Kalpesh, because we've not taken the pain to do a proper cash flow plan. You don't know, maybe you have surplus funds.
exactly.
But you
So-
have no idea, where they're lying and whether they're being put to optimum use.
So that's a brilliant point, Surabhi. It works the other way around, because people always worry about what if I overshoot my income.
Yeah.
But on the other hand, there are many people who are extremely conservative. And when you say extremely conservative is, they do not spend.
Yeah.
But that money is lying idle in the bank account. And neither do they spend it to enhance their proper life or invest it discreetly.
Yeah.
So I think that's a brilliant point. The fourth part,
point?
is again an integral part, which is creation of contingency fund.
Sure.
And I think we had all experienced it, fortunately or unfortunately, I don't know what to say, during the COVID period, that everybody who had a contingency fund, which is nothing but anything between 6 to 12 months of your expenses set aside. I think in those terms were the people who were actually thanking their stars that they had something kept aside. Now this contingency fund, again, be very, very wary where you park those funds.
Sure.
That contingency fund is not meant to generate returns. It's for that rainy day.
Absolutely, absolutely. I just want to move beyond and now talk about this whole business of goal setting and ensuring that my portfolio is in sync with those goals.
Absolutely.
How do we do a portfolio review? Like you said, that's one of the important things to keep in mind as the year starts off.
Yeah, so goal setting, I would say, is attaching a purpose to your investments. So people have various goals and various time frames to, address them.
Yeah.
Now, the question comes, which product do you tag with it? And that is where your investment selection comes into the picture. Now, if you're in a broad framework, if your goal setting time frame is, say, 5 years and beyond, obviously the answer to that is equity would form a major chunk of your investment, because you're not worried what happens in the short term.
Sure.
If your time frame is, say, 3 to 5 years, then something of a hybrid product, which is hybrid funds, or even if you could do an asset allocation of, say, 60-40 on your own, 60 into equity and 40 into debt, that's fine for a 3 to 5 year period. But anything below 3 years is surely a entry into the fixed income space.
Okay.
Because that is where your debt-based mutual funds and all, because you don't want volatility to affect your
Fair
goals
enough,
out
fair
there.
enough, fair enough.
And understand one thing I would like to tell everyone is that if you want to digest your volatility in the capital markets and you want to have a peaceful sleep at night, asset allocation will help you do that.
Okay.
Because come what may in the markets, if your assets are marked according to a time frame and they are the right products, you will not worry about what happens externally to the markets.
Asset allocation probably now people feel is a little difficult because of what you said, because all asset classes are going up together. So I know that we don't usually generalize when it comes to personal finance advice. It's very selective to each individual. But just to get an idea, for someone who is a mid-career professional, a working individual, maybe in their 30s or in their 40s, has a medium risk appetite, what would be like a model portfolio across different asset classes, looking at today's market environment?
Yeah, so with the disclaimers that you said about the model portfolio for a mid-30s type of a person, I would say because he's got 20-25 years of work still left, around 60% should be equity.
Sure.
Now, that could be a mix of direct equity if he's researched and if he has the right sources and if he's doing it discreetly. But otherwise, equity-based mutual funds could form the crux of it. The remaining 20 to 25% could be in debt.
Okay.
Now, again, that could be, if he's a salaried person, it could be obviously the EPF which he's getting, or the debt-based mutual funds, or a PPF, that type of a mix.
Right.
5 to 10% could be gold, which is now, I think, become a compulsion in every portfolio looking at the situation where we are, but don't exceed it and don't be greedy there.
Yeah.
And finally, at least hold 5% in cash.
In cash. It also takes care of the contingency buffer that you
Absolutely.
spoke of earlier. Okay, what we're going to do now is we're going to take a break. So we've done the sort of classroom, the basic theory on how to go about setting up our financial plan at the start of the year. We come back on the other side, and you've been asking us some questions as well on FY25. So we answer all the viewer queries in just a moment.
Let's talk money.
Welcome back. You're with us on Let's Talk Money. And this week we are discussing how we need to start off with our financial plan, review everything because the new fiscal is upon us. A lot of questions are coming in from our viewers as well. We have Abhi Bansal joining us on the phone line. Abhi, hi. Welcome to the show. Tell us, how can we help you?
I'm Abhi Bansal, and I'm currently investing about 2.5 lakhs a month in SIPs spread across small cap, large cap, Nifty 50, tax saving, tech and pharma fund. The percentage-wise breakup is about 95% in equity and 5% in debt fund. And my question is that, if this, the approach that I'm taking, is this the correct approach? If I keep doing this for the next 30, 35 years, how much wealth am I looking at generating?
Okay, Abhi, thank you very much for that. So that's substantial. I mean, investing compliments to you, really. 2.5 lakhs going across different mutual funds. But I think the question is also going to be what you said, asset allocation, right? 95% right now is going in all in equity. He's a young fellow. What would your advice be?
So first of all, like you said, even I would like to congratulate him. That's a very decent amount to, put on a monthly basis. And if you're looking at anything between 10 to 15 years time horizon, if you want to plan it for your retirement, I think you're going to make a decent amount of wealth by the time you reach there. And I think you're also quite savvy in understanding which is the right route to go, because you've chosen the mutual fund route and it's a disciplined way of investing. Only thing like what Surabhi mentioned, I would like to reiterate on that is that 95% aggressive long-term is fine, 5% debt. But if you were to ask me if I were to put my money, it would be for that same thing. I would put it at around 75 to 80% in equity and yet give debt that cushion of 20 to 25% in my portfolio. So go the same debt funds way and slightly taper down your equity component. I think that should stand you in good stead, because believe me that exceeding that 95% is a little on the risky side, whereas the 75% also would do the same job in a longish time frame.
So dial back a bit from equity. Since you mentioned debt funds, Kalpesh, and you also mentioned, rightfully so, that we'll probably start seeing interest rate cuts now. So in this environment, any particular category of debt funds that one should be looking at? Yeah,
so because we're on the brink and we're not started, I would still advocate that people should look at short to medium term, funds, debt funds, because there the time frame is, the average duration is around 3 to 5 years.
Okay.
Because what if people start investing in the longish bond funds and the rate cut does not happen? Because then it might take a hit. Okay. So I would always be on that brink. 3 to 5 years is a decent one, but surely not looking at liquid funds or money market and all those type of funds. So that is a good space to be in. Corporate bond funds is a good place to be in. Banking and PSU funds is a good place to be in.
Okay, those are some ideas on the debt side. If you want to sort of rebalance a bit and allocate a little more towards debt as well. Karan is also joining in. He has a question, I think a very interesting one actually. Let's listen into him. Karan, hi, thank you for joining us. Tell us, what's your query?
Hi, I'm Karan. I want to undertake a long European vacation next year with a budget of approximately 2.5 lakh rupees. I can save around 20,000 a month for this trip. How can I meet this goal?
Well, Karan, okay, I'm almost envious. You're already planning your next vacation. I haven't planned mine, but, great kudos to you. And again, Kalpesh, good way of looking at it as well, right? That you want to save up and have the money in place as well. He's doing 20,000 rupees in equity funds right now. Is that the right way to go?
So equity, if he's been doing it for a while and the goal is coming up in the next year, then probably I would just say that if he's accumulated a decent amount already to meet his target of 2.5, I think in the next 6 months or so, he should surely shift to debt.
Just to protect that.
Just to protect whatever he's made. Because obviously, without looking at his portfolio, everyone has, delivered very good returns in the last 1 year if you're in the right equity funds. So if you have, Karan, already, been investing in equity, I would suggest at least in the next couple of months or 3 months, slowly and gradually start shifting towards debt funds. And in that also, if you have still 1 year time frame, these short to medium term funds should do the job for you. But like what you rightly said again, Surabhi, protection is necessary because you never know when the downfall comes. And you don't want to surely miss out on that European vacation.
Oh, absolutely. You don't want that vacation money going down in a correction. So go ahead and protect it, put it in a good debt fund perhaps. That's Karan's query. Let's move on. Sarah is joining us on the line. Sarah, hi. Welcome to Let's Talk Money. Tell us, how can we help you?
Hi, I'm Sarah. I'm looking to go to the United States for higher studies next year in about 15 months. My course duration is of 2 years. Would investing directly in US ETFs be better for my finances, or should I do it via an Indian broker?
Okay, interesting question. Really looking forward and looking ahead in terms of what your financial planning should be even while you're studying in the US. So I think two parts to it, Kalpesh. One is where you should be investing in the run-up to, going overseas, which is another 15 months that she's got. And the other thing is, I think just start planning your finances when you're going to stay in the US and then whether you should have exposure to US funds.
Yeah, so I think we should answer this in two segments, because the first segment is that presuming US education is a large corpus, which you would have already, I think, been 90% through with that. And now as you near that corpus, the same answer which I gave in the previous question would follow, that protection of that money is important, because again your admissions and all those things would be, there you would be flying out and you want that much money to be protected. So there, if you're still in India, you've invested, then the debt fund can be looked at as an avenue to just cushion that money and keep that separately. Once you are there, I think the second part is, and you want to start your process of investing, like start early type of thing there. And if you have the wherewithal to, get into investments being in US, then obviously to start in the safer way, surely the US index ETFs or index-based funds there on the safer way could be a right thing, but take baby steps, because you are studying and you've always wanted to make a foray into investing, so don't be too adventurous, even if you're doing it in the US. So just take baby steps, go in the index fund way or the ETF and take small strides and then expand.
Let me sort of expand on that question for maybe parents who are watching this as well. Parents who are preparing to send their children overseas for foreign studies to the US, as they look at creating that corpus, should they be incorporating US equities, whether it's direct equity or US funds, or should they limit it to Indian mutual funds?
See, Surabhi, this is a very, I think, off late, this question causes a lot of complications. I'll tell you why. Because the Indian markets are also giving fabulous returns right now. And if you just compare point-to-point returns or something, I think Indian market is doing very well for the moment. So India, I would say that if you don't want to consider that exchange rate risk and all that stuff, then Indian markets, I think, is a more comfort level where you get decent returns for accumulating any corpus.
Sure.
But if you want to keep that currency hedge, then surely we have the, the amenities today, the facilities today to invest abroad as well. But do that very discreetly. Because again, that is something which is not known to you. Indian markets are known to you. And I've always advocated invest in what you understand.
Fair enough. Which brings us actually to the final closing thoughts, Kalpesh. We've discussed a lot of what we should do this financial year. Let's also wrap it up by talking about what we shouldn't do. The don'ts when it comes to financial planning and the mistakes to avoid.
Yeah, so the first and foremost is, always when you're creating a financial plan, take the help of a professional. Because it is something like which is not your expert territory.
Yeah.
And you do not want to be biased towards your own behavior.
Sure.
So that's the first and foremost thing. Second is understand in what you are doing, what are your goals, what is your purpose of investing. Because once a certain goal or a purpose is fixed in your mind, you will be focused. You will not waver from it. And your advisor or whoever is guiding you will make the investments rooted towards achieving your goals.
Sure.
So you won't flounder.
Sure.
Third is the same point what we just mentioned, invest in what you understand. Because today finance is a complex jungle and everybody is on your neck trying to sell his product. And you could be missold and taken for a ride big time. So invest in what you understand. And here I would just like to make a couple of observations in what I would like to say is that do not mix insurance with investments.
Sure.
Insurance is very necessary, but that's for protection. Investments are very necessary, but that's for your growth.
Sure.
Do not have products which intermingle and unnecessarily cause a burden. And second is do not invest in unregulated products.
Got it.
All the get rich quick schemes and things which we are doing here, you will obviously lose money in the shorter or longer term, but it's inevitable. So please stay away from those things. Indian markets are booming. Enjoy the ride with your fasten and your seatbelts on. Just fasten your seatbelts and enjoy the ride.
Fantastic. All right. Thank you very much for being with us in the studio today and helping us sort of start off on the right note when it comes to our finances in FY25. Well, with that, we are out of time on this edition of Let's Talk Money. But remember, you can keep reaching us on either our social media handles or our email ID, askcnbc-tv18@nw18.com. Send us your queries. We'll keep sending you the answers. See you on the show next week.
Let's talk money.